Today's question is about the implications of taking dividends from your own company. Here is a question. I don't really understand the tax implications in taking a dividend, or if taking a dividend would affect me being able to take money out of this year for my pension. Just to clarify, this question has been asked by a business owner who is both a director and shareholder of their company. The company also pays into their personal pension scheme. Remember, the answers given in this recording are of a general nature, and you should seek professional advice for your specific circumstances. Now, let's look at why you would be taking a dividend. Dividends are part of the remuneration strategy that business owners use. If you are a shareholder and a director in your company, you can pay yourself a salary via the payroll and also receive dividends out of the company's profits. The company can also contribute to your personal pension scheme, and this is treated as an allowable business expense, which means that the expense is deducted from the company's profits before arriving at the taxable profits. Before you take dividends from your company, 3 conditions must be fulfilled. First of all is you must be a shareholder. It's not enough to be a director. You must have shares and have contributed to the financing of the business. Then there must be enough reserves to pay all shareholders a dividend, even if some of them choose not to take a dividend. The reserves are arrived after setting aside the amount that is payable in corporation tax. And then you must have the correct paperwork. This must show which accounts have been considered before declaring the dividend. It must show that a meeting has been held to authorize and declare the dividend. It must also show that the reserves were enough to be able to declare this dividend. And it also needs to show the vouchers of how much dividend has been declared for each class of shares. So what are the tax implications of taking dividends from your own company? When thinking about the tax implications of taking dividends from your own company, you need to think about it from 2 perspectives, from the company's perspective and from the shareholder's perspective. From the company's perspective, corporation tax is charged at 19% on the taxable profit. The company then needs to put aside the amount payable in corporation tax before arriving at the reserves available for dividends. It's important to remember that the company does not pay any tax on dividends. The company simply pays out the money out to the shareholders, and the shareholders are taxed in their individual capacity. Looking at it from the perspective of the shareholders, tax is payable not just on the dividends taken, but based on the total earnings from all sources. And I'll explain that in a little bit more details. In the financial year starting 6th of April 2021 to 5th of April 2022, every individual has got a personal tax-free allowance of $12,570. This is the amount you can earn before you start to pay income tax. And thereafter, income is then placed into different bands. The basic rate band is income up to $50,270, which is taxed at 20%. Then the higher rate band is amounts up to £150,000 and is taxed at 40%. And the next band is the additional rate band, which is income over £150,000, which is taxed at 45%. When you earn over £100,000, the personal allowance goes down by £1 for every £2. That is, by the time you have reached an income total earnings of $125,140, your personal allowance will have gone down to 0. So that is how the total income is taxed, but how are dividends taxed? Every shareholder has got a tax-free dividend allowance of £2,000. That means the first £2,000 you take out in dividends is always tax-free. And then any dividends is also just placed in the same income bands as before, with basic rate taxpayers paying tax at 7.5%, higher rate taxpayers 32.5%, and additional rate taxpayers 38.1%. Now, once you are clear on the tax implications of taking a dividend and you're sure you still want to take a dividend, what do you do next? So the first step is to prepare the correct paperwork, or ask your accountant to prepare the paperwork. Let us know if you need any help with this, and we'd be happy to help you with that. You then need to transfer the funds from the company bank account to the personal bank account. Then you need to remember to report the dividends earned in the shareholder's next self-assessment tax return. And the final step is to enjoy the dividends. These are the fruits of your hard work, and certainly well deserved. Hope you found that useful. If you have any questions about tax, accounting, or any aspect of running your business, send them to info@jhawkaccounting.co.uk and we will answer them in a future video. Remember to give us a thumbs up if you like this video. Thank you for watching.